dead gold is sitting, waiting for people to remember it.
Kind of a funny video. You'll never guess where that was. We'll tell you and have more in Loose Change. Let's get to today's Capital Account. Well, we have plenty of news events, like some I mentioned in headlines, to create uncertainty in this economy, to send investors running to safe havens. And an asset we've seen react in the past, gold, sure, it's up a little today, but looking back, it's nothing like this tear it was on.
Gold has traded at another record, $1,645 an ounce.
And gold posted a new record high at $1,815 an ounce.
And the one place people are going is gold.
Gold is trading solidly above $1,800 an ounce. It's now up more than 50% in the last year.
Remember all that? That was in the summer of 2011 surrounding the U.S. debt ceiling debate and the downgrade. And gold even topped $1,900 an ounce at some point way up here. Well, you can see it's come down from there. And it's pretty much where it was about a year ago, despite the types of continued news events that would drive investors to it. Not to mention, according to the World Gold Council, central banks will buy more than 500 tons of gold this year. That's up from 465 tons in 2011, a new high. So what's happened there? And the recent period aside, which we just addressed, we'll get to that, you can see what preceded that was more than a decade-long really, bull market in gold, okay? What we can't see behind this, though, is how much of this has been driven by the types of factors that we talk about every day, okay? QE, debt downgrades. That versus how much is driven by issues such as the 20-year bear market in gold that preceded this run, with the structural changes of supply that happened over a very long period of time, forcing the inevitable price adjustment that we're perhaps seeing today. So earlier I spoke to Eric Sprott, CEO of Sprott Asset Management, and started by asking how he's weighed those factors over the years. Here's what he said.
When I first got involved in gold in a serious manner, which was 2000, essentially right at the bottom of the market, I was sort of guided by a book written by a gentleman who called the 1998 Gold Book. His name is Frank Veneroso. And he surmised, sort of Gatto-like, that the central banks had been supplying the market and suppressing the price of gold. Mm-hmm. And his conclusion was that there really was more demand than supply already back in 1998 of 800 tons a year. And of course, the point of reference is the size of the gold market, which is about 4,000 tons. And I thought, you know, I think he's probably got a point here. Looks to me like there's more demand than supply. And so that's what brought me into gold. That and the fact that I felt very much like we were going into a bear market well before the NASDAQ peaks. And there's only one way to survive in that market, and that's to own real assets. So those two things were kind of my guiding principle.